So good morning in Scotland, or from Scotland and the rest of the UK. Good afternoon in Hong Kong. I think a few of you are calling in from Hong Kong, and Steve Vickers with us from Hong Kong. And welcome to this event from the Asia Scotland Institute. My name is Martin Perbrick. I'll moderate the discussion today and give the introduction. Also from the Asia Scotland Institute is Roddy Gao, chairman and founder of the Institute, and Rick Minchom, our head of development. And our focus today is a discussion of Evergrande and the China property bubble, business and politics, and I think these business economic issues inevitably become political issues in China. We'll have something to say about that. So just to remind you, Evergrande is one of the largest property development companies in China, probably the second largest according to reports, but it's the most indebted property company in the world. The scale of that debt is quite staggering. There's much reporting of the Evergrande issue in the Western media and also related debt problems across the property sector in China. But as with all issues in China, it's always hard to understand the outlook, as information and decision-making in the country are obviously quite opaque. And I think we need the insight from our two panelists today, both of whom have decades of experience analyzing China from a risk management perspective. Firstly, George Magnus is an independent economist and commentator, research associate at the China Centre, Oxford University, and also at the School of Oriental and African Studies in London. George was formerly chief economist and then senior economic advisor, at UBS Investment Bank from 1995 to 2012. That wasn't his only career. He previously worked as chief economist at S.G. Warburg, 1987 to 1995. And many significant economic developments during that period. George has written a book that I think we should all read to understand what's happening in China at the moment, Red Flags, Why Xi's China is in Jeopardy, which obviously is highly relevant to the Evergrande issue at the moment. And the book, if I may, George, Red Flags lists 4 red flags of likely impediments to Chinese economic development, one of which is debt. So I think understanding the nature of that debt and its relation to Chinese growth in the next few years is extremely important. Also, we have Steve Vickers, the founder and CEO of Steve Vickers and Associates, one of the most well-known, I think, risk management firms in Hong Kong and Greater China, specializing in risk mitigation, corporate intelligence, security consulting. Steve has well over 40 years of experience in Asia. He looks far younger. Always. He's an acknowledged expert on political and security issues in the Asia Pacific and a very frequent commentator on political risk and crisis management issues. If I could just say a little more about Steve's background, because he really has been involved in some of the, certainly the major organized crime issues in Hong Kong going back to the 80s and 90s. He's conducted numerous sensitive business intelligence assignments, crisis containment issues, including some pretty high profile kidnapping cases involving property tycoons in the region several decades ago. So the nature of property and how criminal elements become involved has been a long-standing issue in Hong Kong and Greater China. And I think Steve established the first Kroll office. It was certainly the first Kroll office in Hong Kong. I think it may have been the first Kroll office in Asia, Steve, when Jules Kroll founded that firm in the early 1990s. So if Steve is a bit of an encyclopedia on issues for the past 3 decades there. So if I could just remind the audience members, we're on the Zoom webinar platform, so your videos and microphones can't be displayed and only the panelists can be seen and heard, but we do want to hear from you. So please can you raise questions in the Zoom chat function, and then we'll get to as many as we can after George and Steve have given some opening comments. So could I first hand over to Roddy Gao, our chairman. Roddy, would you like to open and start off the questions to George?
I would. Martin, thank you very much for arranging this, you and Andrew. And it's good to have so many people signed on. Steve, good to see you again. And George, good to have you on yet another webinar. We're very grateful. This could hardly be, I suppose, a more timely discussion right now with the apparent well-organized goings on in China, so we're told, compared to the relative chaos of the democratic administration in the United States of America, from which I arrived yesterday. And President Biden arrives in Glasgow without any mandate to do anything of any importance at all. So we shall see what happens. But George, you have a mandate and the knowledge, as the London cab driver would say, and so it's very, very good to have you with us today. I guess right at the center of Xi's and the Chinese Communist Party's policies is the desire and the need to keep the growing middle class satisfied. And if there's anything that dissatisfies a member of the growing middle class, it's when issues arrive around property and real estate. And to pick up on what Martin said, the question is just how serious is this current situation? Can the government in China deal with it? Or is it likely to spread from there? So I wonder if you could talk about that and also give us your overview on the situation at the moment. Thank you.
Well, thanks. Thanks very much, Roddy and Martin, and good to be here on an Asia Scotland webinar again. Well, of course, the situation with regards to Evergrande is and other developers, for that matter, actually is obviously still evolving, because many of them are under quite severe kind of liquidity constraints right now, and face quite phenomenal kind of debt service obligations, not just this quarter, but actually reaching up to about $84 billion by the end of 2022, almost half of which is due from Evergrande itself, according to Standard & Poor's. Just this week, the National Development Reform Commission and State Administration for Foreign Exchange called them the developers into a meeting to ask them to continue to be current on their debt obligations on their bonds, and to report very closely to them on their balance sheet, evolving balance sheet kind of situation. Obviously, the government's putting a lot of pressure on the sector and on the firms to demonstrate that it doesn't really want to be a soft touch for egregious risk-taking and for the accumulation of extraordinary, in some cases, dangerously high levels of debt. So in one sense, we would certainly want to applaud the government for standing firm and kind of asserting moral hazard, so to speak, or the danger of moral hazard. But it's a tricky path, obviously, for the government to tread, because quite easy to fall off that path if you make a policy error, or if you misjudge something, or if something crops up in the kind of the connectability, as it were, of banks and property companies, which is hitherto unknown. I think the likelihood of there being what some people a few weeks ago were labeling a Lehman's moment for China, I think is very unlikely. When the government controls basically all of the actors in the financial system, owns them actually, or many of them, it can parcel around the liabilities and the assets in ways that normally most governments can't do that. But having said that, there's no question that the sector itself is on the ropes, right? So purchasers, there's a kind of a bit of a vicious cycle going on here, with purchasers backing away from the market. It's producing very weak sales, weak revenues, obviously, for the developers. They feel the liquidity pressures, means they have difficulties meeting their debt obligations, which means that purchasers back away, and so on and so forth. In fact, residential investment, it was quite buoyant. If you just look at the maths year over year in the first half of this year, compared with the first half of 2020. But of course, the base comparison actually is very flattering because of what happened during COVID, when it was in its kind of early stages in China. But it looks like there was quite a significant drop-off in investment, sales, and property transactions in the September quarter, for which we've just had data. The prices of pre-owned homes, so that that many of the property companies have deposits that they've raised from people for homes that haven't been built yet. So this has been a way in which property companies raised money when they were restricted from doing so in other ways. So the prices of these pre-owned homes fell in September in 52 of 70 cities, which are monitored by the authorities. And the prices of new homes that were for sale dropped in 26 of 70 cities, which is the biggest since the financial crisis that was made in China, so to speak, in 2015. I think everybody understands why this is important. You know, China's property market was valued by Goldman's at about $55 trillion in 2019. So it's now probably about twice the residential value or residential market value of the United States, 5 times as big as it is in the UK, and 4 times China's GDP. The last time somebody had a property market valuation that was 4 times GDP was Japan in 1989. Many people now also know quite well the graph that was published in a recent paper by Ken Rogoff and a co-author showing annual housing activity in China amounting to about 29% of GDP, taking into account construction investment, housing services like buying, selling, renting, and managing, and the typical products and goods that go into the housing market, from commodities like copper and steel to consumer durables. So that's 29% of GDP compared with a typical 10 to 20% in most OECD economies. And of course, China's never really had, it's had a protracted downturn in property transactions, but never in prices. It remains to be seen, obviously, how the authorities manage the property market in not just in the year to come, obviously ahead of the 20th Party Congress in November 2022, but also during the decade. So for this beleaguered property sector, I would say for the moment, it looks like there is a sort of a knight in shining armor, so to speak, on the horizon. Some help is on the way, according to a report in the Xinhua news agency this week, expressing concerns about what's happened to GDP during China in the last few weeks and months, basically expressing a kind of an angst really about the trust relations between home buyers, banks, and property developers and suppliers to maintain some sort of order in the market. I think it's probably still true to say that there won't be any return to the old playbook of big fiscal and monetary stimulus to bail the property sector out, so to speak. Nevertheless, the government does have to address a number of very important issues, not least of which, of course, is the power supply situation and the property market, and of course to fulfill at least at the start, the beginning of the government's new mantra of common prosperity. The article basically included a spokesman saying it is crucial to stabilize and expand domestic demand, especially consumption and infrastructure investment. So mixed messages in a way, but I suspect that because of the significance of the political year ahead, we will get this winter some measures on infrastructure investment and backing off of some of the tightness of regulations in order for the property sector to get through this very difficult period. However, having said that, I think we also have to think about the kind of the structural picture that the property market represents for China and for the rest of the world in the decade ahead. So last comments I really want to make really about why the property market, whatever happens in this winter and next spring, is actually in for a pretty torrid time really for the foreseeable future. And the first point is that it's oversupplied, basically relative to China's income per capita. So if you look at residential space per person in China, it ranks the same as the UK, France, and Germany. And yet, of course, China's income per head is about a quarter as big. The second factor is that outside of the main urban agglomerations, effective demand is pretty insecure. So there's a lot of problems in China really about job creation, not necessarily in terms of volume, but as high-paid manufacturing construction jobs are declining, there's been this kind of surge in, you might call them gig workers, you might just simply call them low-skill, low-paid. So low-skill, low-paid workers now account for about 60% of employment. And as Li Keqiang recently reminded us, 36% of the population, or maybe I think his number was about 600 million to be fair, or over 40% of the population still barely earn 1,000 yuan a month, which is 115 pounds. Third point is high vacancy rates. About a fifth of China's housing units are vacant, although inventories are much lower than they were in 2015, to be fair. The government Fourth factor is the government wants to stop speculating and leverage. So remember at the 19th Party Congress, Xi Jinping said houses are built to be inhabited, not for speculation. So I think they're quite serious about trying to take the leverage out of the property market and about what they regard as kind of capitalist excess amongst big property developers. The fifth factor is household debt. So household debt has risen from barely $2 trillion US dollars in 2010 to over $10 trillion last year. And the ratio of debt to disposable income, it's mostly mortgage debt, is now about 130%, which is pretty much more than twice what it is in the United States. Sixth, demographics. We all know really last year's population census revealed a 1.3 fertility rate. The number of prime age first-time buyers in China for property is going to go down by 25% over the next decade or 15 years, I would say. Fewer marriages, fewer children, lower household formation are obviously part of this demographic transition. And last but not least, restraint on the part of local governments. Now, they may get after 2025, if the property tax, which is going to be piloted, actually comes into being. I think we should take a somewhat skeptical view about this, but it certainly is being piloted, and taxation of capital is part of the common prosperity mantra. This may come to the relief of local and provincial governments, who, as you know, are kind of dependent for about a third of their revenues on land sales. But for the time being, at least, they will be under pressure. They're not only under pressure from debt and debt service obligations, but also from the fragility of land sale revenues. And of course, they will be required to find resources to validate the Common Prosperity Program as well. So for all of these reasons, I think this is something approaching a tipping point for Chinese property compared with what we've experienced, or what China has experienced for the last 20 or 25 years, which is almost a kind of a relentless and unending boom.
George, thank you very much. It reminds me of Greenspan, and what was his comment about over exuberance in a particular sector? It's a warning of what would happen. But as you said, this is not going to be a Lehman, we don't think. Martin, would you like me to hand over to Steve now to respond?
Roddy, yes. Let me give an introduction to Steve, if I could. And the first question to Steve. So, Steve, you've written about the debt challenges of Evergrande and the wider implications of business. And I think the term I saw in one of your reports is grey rhinos relating to financial risk. And the possibility of public protests. I know for many that would sound a bit of a jump. Public protests from a property company debt crisis, but having worked myself in the 10 years up to 2020 on a major construction project in Guangdong province, have seen firsthand what happens when prime contractors don't pay subcontractors, and then the workers stack up at the gates unpaid and unhappy, and that situation can escalate quite quickly across a sector that has a huge amount of subcontracting. So as you've been watching this for a long time, and I think you have insight into both the political issues and the economic issues, could you give us your views on how the political issues are likely to influence the Evergrande crisis, and vice versa perhaps, and also how you see the political landscape in relation to this debt crisis in the coming year, in relation to the Winter Olympics in China and the Chinese Communist Party Congress in November 2022.
Thank you. Many thanks, Martin. And obviously I will defer to George on economic matters, but I think it's true to say that this is a classic example of bold political risk in China. And investors really do need to consider how they're going to respond. This is not, if I was in trouble, if I had a major investment here, I wouldn't be looking at this as a purely commercial issue. Obviously, commercial risk is the hard thing. I mean, the scale of this is massive, but the Chinese authorities have already warned that Evergrande isn't going to pay, or Evergrande isn't going to pay everything. I think exposure depends on where you sit. Offshore, the risk is much higher. Foreign bondholders are frankly not a priority. Indeed, passing losses on to the US or others is frankly not problematic, provided the impact on future capital raising is not too damaging. What is a bond? I'm a simple man. I don't have George's background in all this, but in my limited experience, a bond was something that got you earlier in the food chain when things went wrong. A bond issued by a BVI Cayman-based entity with a guarantee from a mainland vehicle, which in turn is hence dependent on permission to move money out of China and on their willingness to let you do that. Some of these bonds have what they call keep well deeds of lesser value. Bonds are different things to different people, and these are not bonds as many people might understand them in other environments. Capital controls limit the movement of funds out of the mainland. Permission is certainly necessary. So if domestic liabilities are large, why would you give a priority to, why would one give a priority in such a circumstances? Onshore risk, fundamentally different. I know that everybody says that restructuring of some kind is obviously necessary. The Communist Party prioritizes political stability, and it will not want instability in the markets with the implications for stability or physical security. I think the most important creditors will be those, or the ones more likely to do, but will be the ones who paid for unpaid apartments or have made deposits on apartments. As a failure for them to recover could have a significant social impact. The wealth management products, I think, may be not so favorably treated. Some of them were offering 12, 13, 14% interest. Good stuff if you can get it, but we shall see. Workout of some sort is inevitable, whatever the government say. This is a pretty well trodden path, albeit different. The broad model was put in place by Zhu Rongji in the late 1990s. Other examples were HNA, big banks in the 90s and 2000s, Ambang Insurance more recently. The model is not the same always, but largely speaking, the Chinese authorities take control directly, indirectly, inject capital, order something. The coercive ability to get things done in China, which doesn't exist in the West, is actually useful under those circumstances. The government quietly, in the ones I mentioned earlier, that the government quietly took control, sometimes indirectly through a state-owned enterprise and then carved them up, sometimes injecting capital, all this over a lengthy period so as to contain damage and to a certain extent disguise the nature of the change of the problem. A deep concern is that the Evergrande debt issue has resulted in some companies being effectively locked out of the debt market as investors stay away. We're picking up news reports now of Fantasia, another developer, facing other similar debt challenges. But what are the broader implications, to answer Martin's question? I mean, these developments from a financial or whatever point of view, these are products of acute and rising political risk. Strategic risks include that Xi Jinping is aggressively pushing common prosperity. The phrase, I think, common prosperity actually originated with Deng Xiaoping, who said that the Chinese government would turn in that direction once the economy had developed to a point that this could be done. He's pushed the button on this now and he's decided that the time has come. It also is a great cover. Clarity on what this policy means is still really quite unclear, but it does appear to include a combination of mercantilism, autocracy, and socialized distribution of wealth. Its implications are not good for investors in China or for those hoping for strong levels of growth going forward. But the policy will address some of the horrible imbalances in the Chinese economy to which George just alluded. Regulatory pressures are increasing in all kinds of sectors, such as technology has come under deep pressure with the Ant Group forced to defer its IPO, education, video games, spiritual pollution. And I think the next one that's going to be heavily clobbered is Macau's gaming sector, and in particular the foreign investors within that. Clearly, property is now deeply under the spotlight. The Chinese authorities, in effect, you could say, caused the Evergrande situation, probably unwittingly, by pulling the big lever when the PBOC announced the 3 red lines policy, aimed at quite correctly curtailing overactivity in the market. Broader restrictions are also coming into force in all kinds of other areas. The Ministry of Housing plans inspection to improve supervision, deleveraging rules on property developers, tighter rules on mortgages, local government limiting benefits for housing, investigations into malfeasance. I think there's going to be some horrible investigations into local government, Evergrande employees themselves and others, also that many in the financial industry may fall foul of what has happened. So looking forward, George mentioned the property tax. Clearly, this is a major issue. Any imposition of a property tax would mark a clear shift. Again, George came out with the numbers, but my basic numbers were property accounts for perhaps 28% of China's GDP. Affordability of property is a major concern, worsening inequality. The State Council expanded a 5-year pilot project for tax across China, which could encourage local governments to shift away from reliance on revenues from property sales and leasing. There's a lot of resistance to this. The regions are not clear. I think Guangdong and Zhejiang are possible. There have been pilot projects in Shanghai and Chongqing since as far back as 2011. Efforts to implement the nationwide tax have foundered in the face of really intense opposition from wealthy property people, the middle class, and for fears of a sudden fall in prices. It is possible that Xi now has the political will and wherewithal to push that through. It's a big lever to pull. The risk, I think, is that such a tax could absolutely upset the apple cart. Many Chinese people save by purchasing property, as the financial system offers very little else in terms of interest rates. 70% of Chinese wealth is probably in property. I mean, that's a wide figure, meaning that the slowing or declining property price will directly affect China's wealthy people, the middle class, the core leadership. Provinces depend on property revenues, and so if properly implemented, this step could alter China's whole economic model. Equally, it could cause a great deal of upset. Now, again, George is better qualified than me to talk about that. I recognize the risk. I don't know quite how this might play out. Broader political concerns. Many of these matters are distinctly political. Xi Jinping is looking to the 20th Party Congress, which will probably take place in October or November 2022. A key consideration ahead of this meeting is his determination to stay in office, number one, in contrast to the relatively institutionalized limitations which Deng Xiaoping suggested, such as retirement ages and terms of office and the like. Political positioning is thus a very major concern. And I don't want to get in by going too deeply into this, but for example, Evergrande's boss, Zhu Zhiyan, or Hui Kaiyan in Cantonese, he had strong links to Jack Ma and Alibaba. Moreover, Wen Jiahong, who is the younger brother of former PRC Premier Wen Jiabao, had a 16% shareholding in Evergrande in 2001 and has actually served as a director of the company. This link to Wen was notable because Wen seemingly, again in a publicly publicized newspaper in Macau in April this year, published a tribute to his mother, calling for fairness and justice. This essay is entirely within CCP boundaries, Communist Party boundaries, but was still deemed critical of Xi, and its rapid spread on social media resulted in some sudden censorship. Some reporting later noted that the censorship amounted to the administration's warning to Wen not to intervene in politics ahead of the 20th CCP Congress. So there's a lot of stuff bubbling here in the background that is not just about property and not just about an economic crisis. Other red aristocrats are also under pressure. Zhang Maolong, an aide to Chen Huan, the son of Chen Yong, who was a former vice president of China, who was an opponent of Deng Xiaoping, again in a seeming warning to other CCP princelings, made a pretty big statement. Intriguingly, a lot of this stuff is kicking away in the background. Really, it's not that relevant to investors, but it's important to understand that there's many other cogs turning in the background here, which have nothing to do on the surface with a pure economic situation. Another shareholder in Alibaba then was a company linked to Jiang Qisheng, the grandson of Jiang Zemin. And again, some of these shareholders may not be entirely in agreement or in on the same, maybe on the same line or on the same political viewpoint as others. Fantasia is another property developer currently facing financial distress. The founder is Zheng Baobao, whose uncle is Zheng Qinghong, a former vice president. Zheng Qinghong was known to have close ties to the Jiang Zemin network. Again, it may not be a big deal, it may be a big deal, but these are significant relationships that need to be thought about in relation to the scale of this. What is happening is thus not purely commercial or economic, it's also a political reallocation of the cards ahead of the 20th Party Congress. These company dealings also have a clear political dimension, and the political framework appears to have become more zero-sum than hitherto. So getting to the bottom line, what can a company do about it? What should people who have issues within this do? One, ignoring political risks can result in very deep and sharp losses. Companies need to react by one, assessing political risks to take account of the changing investment climate, the broader policy priorities of the Chinese government, such as efforts to achieve common prosperity. We need to find out what it actually means and how it's likely to play out. Monitoring of new measures that are likely to occur within property or other sectors. Compliance risks need to think about politics, not just technical issues within any given company's business. This is the PRC, not the US, not Europe. Planning and preparing for further investigations. I think there's going to be a lot of state investigations into Evergrande and to local governments associated with that. Some of these may have a political dimension, some may be purely commercial. I think people need to do an analysis to establish what other sections may yet come under pressure from the Chinese authorities. A particular risk are those sectors in which foreign investment is substantial, and perhaps in which unwise investments have made, such as VIE structures and the rest, which at the time were all the rage and are now problematical. So taking account of how this deterioration in relation, and also finally taking account into how a further deterioration in relations between the US and its allies and China can affect investments.
Steve, could I just, sorry to interrupt you, just to ask you a very quick question, as you touched on something before we cut back to George for some more economic analysis. Hoi Kai-yan, the chairman, he was 5th on the Huron Rich list in China. He's now 70th. And there are reports that regulators and the authorities have pressured him to use some of his personal wealth to repay company debt. So Hoi Kai-yan, for example, has a property on Black's Link in Hong Kong, which I'm sure you'll know well. And a property there for everyone on the webinar, a house on Black's Link is valued at 800 million Hong Kong dollars, which is about 80 million pounds. It's about the same size as my little place here in Edinburgh, which costs a lot less. Is that going to be a facet of the problems with these multiple companies that are running into debt in the near future? Will the authorities go after the hidden wealth of some of the chairmen and the management teams running these companies?
Well, usually reliable sources suggest that they've already visited the headquarters in Beijing and took everything away, including the carpet. So I think you can assume that there is a deep level of interest in what's happened. From a foreign investor's point of view, people need to move quickly before they hire legions of lawyers, and I spent a lifetime chasing assets, it's important to find the assets and then work out how to attach them, not to hire a legion of lawyers to give you advice about something that you can never execute. So those that have that have a concern, they need to be moving quickly, and they need to be moving now. Offshore assets, for sure, the government is on it. I think he's lucky to be as low down the list as he is, and to date, and one wouldn't wish anybody ill. To date, he remains at liberty. But the scale of this, is a very, very large problem. There are concerns about what happened with local officials in local environments, and what was allowed to occur and what didn't. And it would surprise me very much if there's not some strong action taken soon.
Yep. Okay. Steve, thank you very much. Excuse me, I need to cut back to George, because I have quite a few questions now, and want to give time to get as many in as possible. George, Dr. D, I'm afraid I don't have his full name in the audience, asked you that you mentioned that there may be little government intervention, and I think he's referring to what you talked about in terms of economic intervention. How does that match with the overriding need for social harmony, and will harmony be managed in other ways? And the questioner also asks, secondly, when we talk about debt, we mostly talk about known debt. What about local debt? And I think what we're getting onto there is hidden debt. So obviously there are reports of the scale of Evergrande debt and the scale of the debt of other large conglomerates. And I think also, obviously, for the benefit of the audience, Evergrande is not just a property company. Obviously, the problem with this company is it's diversified into 100 other business lines, many of which it's not very good at. So are we seeing the true scale of the debt from this company and other similar companies? And perhaps to let you talk a bit more about the outlook economically for that. Is that going to impact, do you think, Western investor confidence in large Chinese companies, conglomerates in the next several years?
Just taking the first part of that question, I mean, little government intervention and social harmony bit. I mean, obviously the government's in a very tricky position, right? It wants to, and like so many things in China, perhaps so many things everywhere, but certainly in China, nuance is, the watchword really. So it came out very strongly, as people may remember, in 2016-17, after the mini financial crisis of 2015, very strongly with the idea that actually, the accumulation of debt as a model or as a basis for economic growth actually would lead us down very, very dangerous paths. People may remember the anonymous article that appeared by Liu He, so it wasn't that anonymous in the end, on the front page of People's Daily, but it was anonymous at the time, which basically kind of kicked off the whole discussion really about, they're finally going to get on top of this. And actually, to be fair, I mean, the growth of credit creation since 2017 has kind of slowed down. There was a bit of an aberration during the pandemic for obvious reasons. We might see another kind of blip over the winter and the spring for reasons that I just mentioned. But I don't think that, I honestly think that the government is intent not to rely on pumping the kind of credit accelerator to try to get it out of a hole. But this basically speaks directly to the problem about social harmony and political stability in China, because the biggest script in this kind of rather narrow discussion about credit creation is China's development model needs a makeover. And I think the leadership is well aware of it. The trouble is, I don't think they have yet been able to articulate a model which is politically acceptable. They don't want to go down the kind of capitalist route, quote unquote, of opening up the consumption part of the economy. They don't want to liberalize the service industries too much. The whole industrial policy recalibration is really about state enterprises returning to the commanding heights, so to speak. So what we as kind of liberal Western trained economists would argue, and do argue, that the next stage of China's development ought to look like is not something which the party accepts. But I don't think they have yet been able to articulate what it is that they do want, other than to talk about or to mobilize a campaign behind this common prosperity, which is, it's about social goals in a way, but it's not really a development model. So yeah, I think the idea of harmony, in China actually is a little bit to be discussed, because I don't think that the economy, whatever they might be able to fix in the short term, is really going to be responsive to that over the medium term. The debt situation, I mean, people try really, really hard to get a handle on how much debt there is. I think we do have an idea, much better now than we did, say, 10 years ago, about local government and provincial debt. We know maybe only when Evergrande is finally restructured will we actually find out, what its true levels of liabilities are. But, give or take, 305 billion is a good enough number, actually, I think.
Yes, it's a large enough number, certainly.
Mm.
Yeah. While we're still on this macroeconomic point in the outlook, George, I think there's a very good question, if I could stick with you for a moment, from Michael Kurtz, who refers to something you mentioned earlier on in some of the points you made describing the state of the property market and comparing that to Japan in the 1990s with a level of property value to GDP, and I quote, well above OECD levels of property intensitivity of GDP. I'm not quite sure if that's the right term, but and Michael mentions that in your introduction you concluded there may be a pivot point, and I think you're sort of alluding to the pivot point that came with Japan with a slowdown in growth in the 1990s. Could you say a little bit more about that as a macroeconomist? Do you see this as a pivot point for the Chinese economy? And do you see, as Michael puts it, an orderly downshift in GDP growth or a disorderly slowdown? So how much of a pivot point do you think this may?
Yeah, well, if I was equivocal about it before, I apologize. I don't mean to sound equivocal. I mean, I think it is a pivot point, because for the last 20 or 25 years, while China's housing welfare system was transformed into a full-blown market system, it's never really had a kind of a protracted down cycle. And we had some pretty weak property transaction numbers in 2015, weaker than they have been so far, but this is early days, I think. But there was never really been a kind of a meaningful drop in property prices as such. And the arguments that people use to say why that might not happen is because inventories of property are quite low, and because China's housing market is not as financialized. It's not as kind of commoditized in financial markets as it is in the UK or the US, for example. And both of these arguments kind of stand up certainly to scrutiny. But on the other hand, there are kind of fundamental laws of economics and demand and supply. And for various reasons that I mentioned, I think the underpinnings of the property market going forward are pretty weak. And so I think that there's a strong likelihood, actually, that we will see, certainly in real terms, I think that property prices will stagnate for quite a long time. I don't mean for a year or two, I mean like for a decade. Bearing in mind that 40% of loan transactions in China use property as collateral, bearing in mind, as Steve alluded to or mentioned already, that 75% of household wealth is in the form of property. Bearing in mind the reliance of local and provincial governments on elevated land prices for raising revenues that finance their expenditure. I mean, China has a lot to lose from a period of stagnant property prices, even if they don't actually drop, like a stone. So and the trouble is there isn't really anything that's going to make up for the loss of the dynamism of 29% of GDP. So where is the sources of growth going to come from? So I think, you know, my view is that I think China's growth rate is really, it's been slowing for a long time, as we know. I think it's going to ratchet down to something close to its potential growth rate now, which is about 3%. And we should not exclude at least a period in which there may be a kind of a recession with Chinese characteristics, whatever that might mean. But there could be, you know, I mean, growth in the third quarter of this year, quarter on quarter, even on official statistics, was 0.2%. So basically a hiatus. It might not be that much better in the fourth quarter. It might get a bit better because of the 20th Party Congress next year. But I think it is, I think that pivot point really is about, you know, moving into a different, you know, a much lower growth environment without an alternative model to pick up the baton, to raise productivity, which is what is the bottom line. And what will the reactions be for, you know, civil society in China, and for, you know, what the different kind of factions within the party think about the direction in which China's headed economically. I think it's a very, you know, interesting time, as they say.
It's certainly an interesting next few years, and I think even if we look at the UK budget yesterday, there's year-on-year projected growth of 5-6%, I think, but obviously that's from a low point in the last 2 years, so it's far higher. But looking forward, I think the figures from the independent monitoring of growth are for 2024, 25, 26, less than 2%. So it seems that most economies in that period are going to be facing a potential slowdown, obviously, which is quite troubling.
That's normal for us, but it's not normal for China, though.
Exactly. Yeah. Steve, cutting back to you, we have a question from someone in the audience who, as he puts it, is on the great island of Lantau, which it certainly is a lovely island, where you live as well, I think. And the question is, I wonder if you could say something about the wealth management schemes that Evergrande appears to have been running over the past few years. How come these sort of high risk investment schemes have been tolerated for this long by the authorities? What's the government's appetite for cracking down on this kind of high risk yet popular financial product? And will they risk public anger if they don't step in to protect these specific investments? I think there's a lot of questions there about how the government manages the failing investments in those conglomerates, similar to Evergrande, and then deals with the public anger when people lose money. How do you see that going?
Well, we say the government, the local governments have encouraged a lot of the activity to date. And I do think, as I said earlier, that the people who invested in property will get a higher, or put deposits to buy actually a house or a house, will probably, will probably come through this. I don't detect the same level of sympathy or interest in those that were banging in money for 15% returns at a time when that just wasn't achievable. So I don't know what. It's a huge problem. It's a national problem. It's a local problem. There is some discord, I think, between what local officials think and what national officials think. I think the party congress coming up in October, November next year is a big pivotal date. It's things are going to be clarified one way or the other. Heads will be knocked together one way or another, and there will be a clear direction, whether that is property tax or whatever it is. I think that's a date. The dates leading up to that, I think, are important. I think that's where the political decisions and the practical implementation will have been considered. But I don't think anybody who's the people, the so-called foreign bond holders with bonds in inverted commas, through offshore companies, through whatnot. I mean, these people, I think, are find themselves in deep doo-doo.
Thanks, Steve. George, if I could come back to you, a question from Giles Chance, who I believe teach at Peking University. and spends some of his time in France at the moment, where he has a very nice chateau, I think. And Giles pays a lot of tax in France, and in particular, he's mentioned he pays a large a foncière tax every year, which I believe is property related. And Giles asks, isn't a Chinese property tax a fair and sensible way to increase government revenue, much of which will be needed by local governments in China? But perhaps we could expand on that a little bit further. Do you think we may see increased reform of the Chinese tax system because of the government needs to restructure that for revenue raising?
Good question. I think everybody, I don't know about everybody, most people, including obviously Chinese leadership, thinks that a property tax probably is a good idea. And it's certainly something which has been, I think as Steve said, it's been on the political agenda since 2010, 2011, with 2 pilot schemes for, I think probably for second homes, if I'm not mistaken, but I could be mistaken, in Shanghai and Chongqing. But the problem is that it's been difficult to get it to be enacted as a nationwide tax because there's visceral opposition to it, notwithstanding its benefits probably for local and provincial governments and for the functioning of the property market itself. And the opposition comes obviously from urban residents who, for obvious reasons, because they will be losers and they have to pay more tax and they, most of their wealth is tied up in property. They fear the impact of falling property values, and from local and provincial governments themselves, who fear the same thing, although that may be an exaggerated fear. So, I think most people agree it's a good idea. It should be introduced, but it's not an easy thing to do without pain. I mean, it's any kind of big tax reform is going to enact or involve losers and winners. But you also have to kind of think about this in the context of the nature of China's tax system. It's a very regressive tax system. Only about 5% of total tax revenues in China come from income tax. The lion's share come from value-added tax and from payments made by companies. So in a way, property tax is really important. It should be introduced. It should be a nationwide tax. It's not going to happen before 2025, even if it happens at all, because of what the government is. It's gingerly going forward with this. But actually, the new model, quote unquote, for China actually needs to embrace much more comprehensive tax reform about the way taxes are raised, who pays them, how they're raised, and to define the tax and spending responsibilities better between the central government and local governments. So this is something that they've tried to do before. The last big local government financial reform was in 1994, but we've kind of gone all the way back to the way things were before that. So in other words, local governments are responsible for most of the spending, but most of the revenue goes to the central government and so on. So these things have to be kind of in the melting pot, really. So short answer to Giles's question is, yeah, it's a good idea and it should proceed, but not to look at it, don't be blind, obviously, to the opposition there is to it, and also to the bigger question of the tax system.
I suspect Giles will continue to pay more tax in France than he would in China.
He probably will.
Yeah. Okay, Giles, there's a message there. Steve, you mentioned something earlier about Macau gaming sector and the license renewals there, and I know it's a subject you know a great deal about, having done a lot of work in that sector. I think it's relevant also for the wider economic outlook in China, especially for international investors. So we have several questions on this, asking you to elaborate a little bit more, in fact, about the economic implications you expect to see in that sector. Obviously, Macau is completely dependent on the gaming sector, but in particular with license renewals coming up in 2022, and let me see, I think there are 3 primary licenses that are US entities, and they're long-term licenses, obviously. What does this imply for international investors, for long-term businesses in China? You mentioned you thought that several of the foreign license holders may suffer in the coming round of licensing. Do you think licenses may not be renewed? How do you see the outlook for that sector? And how do you think that may relate to international investor confidence in long-term business?
Well, there are degrees of suffering. Suffering can be you're out, you're gone, you've lost your concession. Thank you for the experience, and leave your building and you're gone. That would be very extreme. What would be less extreme might be an encouragement for various people to up the shareholding from others who are seen as more favorable. There's certainly no reason why the central Chinese government would feel obliged to prop up US-backed casino operations at a time when relations are pretty shocking and getting worse. Neither do I think. So I think the answer will be somewhere in the middle. It's a hot button. The chief executive of Macau, who isn't actually making the decisions, but is a very significant figure in the middle of it, is not a particularly pro-casino guy. He's not, unlike his predecessors from that world, are as connected to that world. Clearly, everybody knows that as you say, Martin, it's the only game in town. But there are some clues. There's been pressure on junket operators to consider electronic renminbi to move money. As many people know, Macau at its height, when everything was yabba dabba doo, as they used to say, Yogi Yogi Bear and the rest, at its very height, the official registered taxation or turnover for the purposes of taxation was 43 billion United States dollars running through Macau. In reality, that number was probably 5 or 6 times that because of the side betting in the VIP rooms. We're talking about a very, very, very substantial number, a massive capital outflow, which was at that time, not now, at that time acquiesced to, if not agreed to, by the central government, because it afforded in those days they were scared of inflation, and it afforded a ventilation system, which also put some money in other people's pockets at roughly the same time. So that's why it was tolerated then. Capital outflows are clearly not what they want to see happen now. It is illegal for a Chinese citizen to move more than a very limited amount of money from the mainland to Macau, and yet officially 45 billion, and in reality far more was allowed to happen. So this is something that is going to be cracked down on. The triad control of junkets or triad involvement in junkets is well known and continues. So there has been progress in that direction. So I do think that this is a serious issue. Listening to people who are employed by the casinos telling everybody that everything is going to be okay is probably not the wisest, is not probably the most independent or wisest way to review that. Pension funds have major investments in the bigger casinos operations. They really do need to know. Political issues are huge and are the biggest issue that impact this. The largest investor, for example, in one of them was the biggest donor to Donald Trump's campaign last time around. So, I mean, these are real factors. So I would say it won't be the end of the world, but I don't think everything will stay the same. And I do think that we'll be up for a few fasten your seatbelts in Macau.
Interesting point, Steve. When you touched on capital outflow there, which I think is important because having looked at that sector for a long time, as have you, the extent of the capital outflow through Macau, I think, wasn't well understood. And I do remember briefing some officials from the Ministry of Finance in Beijing about 8 years ago from a Hong Kong perspective. And we did ask them about the capital outflow through Macau, and they did say that it's not something they wish to report because they don't know the extent. They didn't know the extent, and I think that's common with problems in China. Middle level officials often don't know the extent of a problem. It's not reported to the state council level, but when the state council finds out about the extent of it, they crack down very, very hard, and that comes with many issues in China. For a closing question,
could I just say on that, what I've noticed recently is the Macau settlement system, which is the junkets and the people that move the money around. That system is now being diverted into Southeast Asia. Yep. So we're seeing that system being used to the detriment of the mainland and the detriment of Macau in Cambodia and in Vietnam and in the Philippines, none of which will come as a surprise to you, Martin.
Sure. We're going to have another event soon about underground banking, which this is a major part of. But if I could close with a very brief question to George, if we could. And I think there's a pretty direct question from Phil Graves in the audience, who said, what are the implications for foreign bondholders in Evergrande being burnt on future levels of foreign investment in China? And to put that in perspective, I'm told by people I know in banking that Evergrande bonds are at 20 cents on the dollar at the moment, and that's pretty good value to many in banking. George, should we be buying at the moment?
Well, I mean, I can only really echo what Steve started off by saying in his introductory comments about having to think about investment in China nowadays with a political risk hat on as well as a commercial risk. And I think that's, I mean, that message really has come through loud and clear through this, what I call blizzard of regulation that's been taking place really since the abrupt pull of the Ant IPO last November. We obviously don't have to go through all of this now, but let me just put it this way, just to be brief. I mean, I think what's going on, I mean, this isn't an all-out assault on private enterprise, right? I think the Chinese government really still, does see very important and significant role for the private sector in China and for the normal ways in which private companies raise capital, including from bonds issued overseas. But I don't think there's any question really, if you look at the regulatory environment in a kind of holistic and political way, which I think you have to, you can see here something there's a bigger script here, which is really, I talked before about, state enterprises returning to the commanding heights, the primacy of being led by state investment funds and state enterprises. A lot of the parts of the private sector are being made or being forced in a way to be, that they're almost being like taken over from the inside, not by nationalization, but by the deployment really of party cells close to operational management. They're being instructed or being advised to take a bigger role in compliance, in recruitment, in staffing, in setting goals. The whole concept of what the Chinese call tertiary distribution, right? Primary distribution is wages and salaries. Secondary distribution is taxes and transfers. Tertiary distribution is the role that private enterprises play in making donations to party, goals and programs that are championed by the party. And I call it coercive philanthropy, which is basically, billionaires and private enterprises basically moving funds into programs that the government says are important. So it's very much, united front work department type of activity, which is to ensure that private enterprises' interests are aligned with those of the party, even though they may not be a formal part of the party structure itself. This is a very, very different investment environment from things that people grew up with. This is not the kind of the investment environment that you thought you were, when you bought your ETFs, I don't know, a few years ago. This is different. You need to understand the political risk involved, and that's not to say that you can't do good stock picking in China. I mean, I don't want to kind of get away from that at all, but I think you have to be, a little bit kind of wiser about what you do with your money and whether you're paying the right price.
Yeah. George, thank you very much. I think you've capped off Steve's comments on the necessity of political risk awareness and understanding in relation to economic investment in China. on a broad level, and that's obviously what we hope to do through what we do at the Asia Scotland Institute. On that note, Roddy, could I hand back to you, please, as chairman? Thank you.
Martin, yes, thank you. And thank you for arranging what is, I think, everybody would agree, has been an absolutely fascinating discussion of the situation in China, from, on the one hand, a macroeconomic standpoint, and on the other hand, a due diligence security aspect as well, both ends of the same, if you like, piece of string. And it epitomizes what we try to do here at the Asia Scotland Institute, as you have said, which is not just for Scotland, but for elsewhere, to broaden people's understanding of what is going on in Asia. We've been talking about China here particularly, but in Pan-Asia, so as especially to educate and inspire tomorrow's leaders in Scotland and elsewhere, so that they can understand how to engage with the markets at the moment. And so to you, George, and to you, Steve, thank you very much indeed for the really, really interesting discussion we've had. To Martin and to Rick, thanks for having set this up. And to all those who, there are still very many participants online, to all those who've listened, we hope you found this an interesting webinar and that you will continue to support us in what we do. Thanks very much.